Looking at global equities in July, we had a very strong month for investors. We were able to finally breathe a sigh of relief after the strong 21% sell-off we'd seen calendar year to date. What we saw during the month was a little bit of bad news is good news. Some economic weakness that started flowing through started to get investors thinking that maybe the hawkishness or the speed and duration of rate hikes we'd see from central banks may not actually be as bad as originally feared. So we did see interest rates and what the market tends to follow, US 10-year nominal yields, fall quite aggressively. So at their peak this year, up around 3.5%, falling closer to around 2.65% at the end of July. And what we saw, given interest rates are really the gravity of markets and really what determine overall valuations, was we saw valuations rise sharply during the month, again, with the overall market up around 7%. Looking at sectors, when we think about those most sensitive to interest rates, it really were growth stocks and the growth type sectors that did incredibly well. So consumer discretionary and IT being the best performing sectors, up around 12% during the month, but all sectors did rise. When we look at that regionally, there was a little bit more dispersion. So the US market was very strong, up around 9%, as that market tends to have a lot more exposure to these innovative style companies and sectors. We also had India, that was a very strong market in Asia, as people are starting to see the pent-up demand being released in the economy, but also that economy does benefit from falling oil prices, and we have seen oil fall over the past 2 months. Also in Asia, it was a particularly weak month for China. So in China, we have seen things go from bad to worse, and now people are starting to think, despite some of the stimulus efforts, how bad may the contagion be with issues in the property sector? So we did see more investors leaving the Chinese market during the month. Overall though, outside of rates, we also had US earnings season. We started to get anecdotes of how well or bad companies were going, and overall it was an upbeat earnings seasons with a broad beat to estimates. However, we did start to see third quarter estimates decline. And this is really the first sign of earnings weakness or expectations of earnings weakness we've seen post-COVID. Some anecdotes from earnings season we did receive. We did see companies continue to emphasize some of the supply chain issues, some of them not being as broad-based but more nuanced to their companies and sectors, but also very unexpected. We also started to see companies thinking forward about rate impacts and potential recessions. So we started to see more companies announcing hiring freezes as well as layoffs. What we also saw were companies saying they are already starting to see the spending patterns and behaviors change from households and corporates. So very early signs that these rate hikes are flowing through to real companies, flowing through their expectations and operations, and that they're starting to have the desired impact of slowing down demand. What's encouraging to us as we look forward is that companies are really starting to right-size their businesses and prepare for this in advance. And this could be something that does dampen the impacts of the recession and could see us reach a floor in markets sooner than expected.